Yo, what's up, guys? It's your boy Looney. I am seeing a lot of people turning bearish on the stocks they own after a steep decline. A few of them are names like Hims, Snapchat, Mara, SBET, SMCI, and more. First of all, most of these positions are meme stocks anyways. You need to keep that in mind because a lot of these positions that are all over the internet aren't going up because of fundamentals. They're purely driving because of hype. So before you start panic selling, you need to remember why you invested into these positions in the first place. Now, the other thing is stocks can't go up forever. There has to be healthy pullbacks. Sometimes these pullbacks can last weeks or months, and if you're going to be in this game, you have to be comfortable with the stocks going down in the short term. Let's look at an example like Mara. This is a stock I own, one of my bigger positions, about 5%. Past year has not moved. It is actually down 2%. So it hasn't really gone anywhere. It's mostly been moving sideways, but if you notice, there's been a lot of volatility. The stock moves up and down quite a lot, but in the long term, kind of returns back to its base. So a lot of people might think this is a bad investment and say nothing is happening. And most recently, the CEO or insiders of Mara have been selling their shares. So that's why it has seen that volatility recently, while other positions have actually performed pretty well. But you can still make money even if your stock isn't moving. And how do you do that? And that is by selling options. So you can make money if the stock goes up or down by selling options. If you own the shares, you could sell covered calls and get paid up front. But if you don't own the shares, you can sell cash secured puts at strike prices that you're comfortable owning the stock. Either way, you're collecting what's called premium while everyone else is sitting there frustrated. So I currently have 200 shares and I have both strategies going on. And I have an $18 call, a covered call, and a Mara put, $14 put. I believe this is actually called a strangle or straddle. I don't remember, but that's not too important. It's basically when you do the same strategy, same expiration or similar expiration, and that's what I'm doing here. So I have a sell call at the 18, sell put at 14. And I'm being very strategic. So I'm not doing this every week, every day. I'm doing this when there's opportunities. So when Mara goes up, I'll sell a covered call. And covered calls aren't a bearish strategy, but they do help. They give a slight hedge and you get to collect income if the stock moves sideways. Cash secured puts are a little bit more bullish strategies, and you can do this when the stock is on a red day or at a cheaper price. So that's what I did when Mara was cheap. And let's actually look at it. So I opened this position on the 1st of August. And if we go to this 1 month chart and look at August, we can see how much it declined. It was down 24% just from the month chart. And then if we go back to that $18 covered call, I opened it on the 11th of July. So let's go back to July 11th and see where it actually was. So it was somewhere around there, but let's go a little bit further. So July 11th is when I sold a covered call. So I didn't time this perfectly. The perfect top would have been around that $20. And that's just because I've been rolling options, but you can see I'm selling covered calls when the stock is expensive and then selling cash secured put when the stock is cheap. And if the stock continues to decline, I'll just sell more cash secured puts. So this isn't a lottery style strategy. I'm being very specific, very strategic, and choosing this at the right points or right moments. So if Mara goes down to $12, $10, I'm going to continue to sell puts, get that premium, and also sell covered calls. And if things get really low and the entire market's kind of affected, then I might go into buying strategies. We're not going to go over that here, but I do have some strategies where I buy long-term leaps. So you can see there, that's my open position, but you could actually see that I have made money from just holding Mara and it only going sideways. So I have this sorted to show all my profits. If we go to all and we scroll down to Mara, I actually made $2,000 just from the stock going sideways, and that's really from selling options, selling puts, selling covered calls, repeating this strategy. Now, some people might say, why don't you just move your money to a high yield savings account where you can get similar returns? Sure, those aren't volatile and you can get a fixed return. So that's good in the sense where you're very defined, you know what you're going to get, but you don't have as much control. You can see here when Mara is low or stock is low, I could sell a put, and when it's high, I could sell a covered call. When you have these high yield savings or these ETFs, you can't really control these things. If it declines, sure, you could buy more, but do you know if it's going to go lower? You don't. And covered calls are pretty good at that, and just overall selling puts are good at that because you get that premium. And you get more control, and it's a little bit more leveraged. You get to choose your strike prices, and you can actually earn more than that yield while keeping exposure to a stock you actually like. And then on the other hand, someone might say, why not just do a yield max ETF like you have MicroStrategy or MSTY? But the problem with these is they do often underperform, especially in a bull market. These underperform. You can see here, it is actually down. Year to date is down 28%. And again, you don't have as much control. Sure, you get paid a lot of income, but you can get that same strategy by investing into a stock that you believe in. Although Mara is cheap and low, I do believe the stock can grow to $20, $25. We've seen it before. And when it gets to that price, you can sell covered calls and collect even more premium. So that's the beauty of selling options. You don't need massive moves to profit. Whereas a stock could stay flat, go slightly up, or even slightly go down, and you're still collecting a premium. So before you dump that stock like HIMS is one that I own and did see some volatility. Before you go and try to panic sell this, it's not just because it's not mooning yourself. You need to ask yourself, can I turn this direction into income and overall profit? If the answer is yes, then the better move isn't to sell the stock. It's actually to invest more, whether you want to sell options or just simply buy the dip. And you need to be strategic. Yes, there is a saying that says time is better than timing, but sometimes you don't want to go lump sum. You want to DCA. So you could DCA with selling options, or you could just simply buy the stock small portions at a time. So if you enjoyed this video, don't forget to leave a like and stay patient, sell options, keep stacking those premiums. Peace.